Thank you very much. Muchas gracias, Mr. Wunsch. I take away that companies providing payday loans and flash credit somehow need to be regulated, and that when you have wealthy parents, the bank needs to make some explanation, additional explanation. So I took away those two things. Now, if I could invite Stuart Holland and his panelists to come onto the stage, please. Stuart Holland is Head of Governmental Relations Europe at Equifax. He's also non-executive director at Indus, an Equifax company that works with over 50 public sector clients. Stuart has worked in financial services, regulation, and chaired a mental health charity. Stuart will moderate our first panel discussion. How can the CCD II spark a boom in more responsible credit? I remind our friends in the audience that questions are not only allowed, but they are encouraged. So please start using the Slido for your questions. I am very much looking forward to your conversation, Stuart and colleagues. Thank you.
Thank you, Enrique. It's lovely to be introduced. I haven't had that for a while. Thank you. So 2008 was a very big year for those of us who get excited about the regulation of credit, and we do exist. Our hearts beat a little bit faster because we instantly remember, of course, 2008 was the year that the European Union published the Consumer Credit Directive to harmonize protection in the consumer credit market and to stimulate a single market in consumer credit. Something else big happened in 2008 that would also transform our lives. So 2008 was the year that the first iPhone became available in most of Europe. Nobody was sure if it would be a hit. A phone with no keyboard. It wasn't 3G. What would you do on an internet phone? So I think you can forgive the authors of the CCD for not foreseeing what happens when you put these two things together. Consumer credit and then a supercomputer in every handbag, every pocket. That we would use phones to get credit, that we'd see booms in new types of products, buy now, pay later, payday loans, that type of thing. And that we'd have open banking, GDPR, so much more. So the time is right, obviously, for a refresh of the Consumer Credit Directive. The Committee published a proposal in June last year. That proposal would cover more products, so loans below 200 euros, buy now, pay later products. It would give different information to consumers when they apply for credit. And there's a stronger creditworthiness assessment, so more of a responsibility for lenders to check that people can afford the credit before they grant it. Big debate now, as we gather, in the Parliament and in the member states, be potentially saying how credit should be regulated for the next 40 years. Big questions about the Commission's proposals. So, is the scope right? Is it right to regulate small value loans like bigger value loans? What data should be used in a responsible lending decision? Will the proposals do enough to help people get access to credit they can afford and to protect them from problem debt in a cost of living crisis? Big, big questions, but I am fully confident we can resolve them in the next 50 minutes or so, because we have assembled the greatest consumer credit panel one could assemble in the European Union today. First, we're going to have two case studies from credit reference agencies on how they're using credit data in new ways to make the creditworthiness assessments more accurate. They're short, 5 minutes each. So up first, we'll have a colleague of mine, Fiona Gatchell, who's head of transactional analytics at Equifax. Fiona's on holiday today, so has recorded her case study in advance. Then we'll have Urte van Raczeck, head of regulatory management at SCHUFA. Then Urte will join us with our panel, who are Tomislav Sokol, MEP, who is very, very close to the law and the politics of the Consumer Credit Directive as Shadow Rapporteur for the European People's Party on the Internal Market and Consumer Protection Committee. We also have from the Commission, David Ciliberti, who is Legal and Policy Officer at DG Just in the Commission, leading on this file. We have Anna Martin from BEUC, Europe's #1 consumer organization, of course. And we also have Sebastien de Brouwer, who's Chief Policy Officer for the European Banking Federation. So let's start. Urte, sorry, not giving you the chance to prepare, but would you be okay to go first? All right. Up first in that case, Urte von Raczeck.
So thanks for having me today. I'm Urte von Raczeck, Head of Regulatory Management at SCHUFA Holding AG from Germany. And I'm very pleased to share some of the insights on what we did at SCHUFA. We analyzed how does scorecards evolve when we add different data sources, when we use more comprehensive data. And as Pia Wunsch already said, I mean, the world is changing. There's no more personal contact between consumers and lenders. So a creditworthiness assessment, an accurate creditworthiness assessment is more important than ever, because you need to assess the risk that is related with taking credit for consumers, but also for lenders. So the next slide, please. At SCHUFA, that is exactly our task, our role. We support lenders with information on worthiness of consumers. At SCHUFA, we have nearly information on nearly all German adults in our database. We obtain this information from public registers, such as debt and insolvency registers, but most of our data comes from our clients. We call them contractual partners. See here, we work or we share information with clients from different sectors, with clients from the banking sector, but also with clients from the non-banking sector. We work based on a reciprocity principle, which means that clients that obtain information from SCHUFA, they also share information with us. So with the banks, we exchange information on positive data, so-called open accounts, loans, credit cards, which are repaid on time, but of course also on negative information if there would be overdrafts or arrears. And with the clients from the non-financial sector, we only share negative information, so on payment arrears. And here, the next slide, please. I'm very happy to share or to give you some insights on what we analyzed at SCHUFA. We analyzed how does the predictive power of scorecards evolve if we use different data sources, we combine different data sources. So in the first scenario, you have here the scenario that we only use public information, public negative information. And you see this yellow bar that represents that we have like not real information about the consumer. We do not really know something on the consumer. So there is no good risk, but no bad risk neither. So it is hard to estimate whether a consumer can afford credit or not. And especially in Germany, we have the challenge that we do not, or we cannot use an identification number such as the tax number, because we're not allowed to do in Germany. So if there's no information on the consumer, we cannot estimate, or we do not know the consumer. If we add in the second scenario information from the banking sector, from the financial sector, you see that the differentiation between the consumers gets a lot better. So we have like this green bars that represents the consumer, which would usually get good scores and which have lower risks when taking up credits. And of course, we also have the red bars, a small number of red consumers, which already have payments arrears in the banking sector, which have overdrafts in the financial services industry, and who probably would not afford getting another credit. And if we add further information from the non-financial sector, and if we use the whole SCHUFA database, we see that the predictive power of scorecards rises. So there's a 12% rise on the overall scorecards if we have the different scenarios. And if you just look at the green parts, you see that they, from the second scenario to the third scenario, they become 50% bigger. So that means that we can identify 50% of the consumers or more consumers with good risks and who can afford credit and who would probably get credit. I mean, lenders always use their own data when doing the decision, but at least what we inform them, we would grant them or give them a good score. And of course, there would also be like the consumers who have arrears in the non-financial sector, for example, in the telecommunication sector, and then they would move maybe from the green areas in the second scenario to the red areas with not so good scores in the third scenario, because, for example, in a payment area in the telecommunication sector can, of course, be an early warning indicator for maybe future payment areas in the banking sector. Yeah, so what is our conclusion? Consumers benefit from using comprehensive data because we can identify more consumers, we can financially include more consumers who can afford credit. So this is, and on the other hand, we can also identify consumers which have a high risk of getting over-indebted and who would not get credit. And lenders, of course, can reduce their risks and can offer that pricing to consumers. Maybe just go to the next slide and the conclusion, and I'm very happy to have your questions if there would be any, or maybe after the next case study, I don't know. Just
thank you. Let's set the questions together later, I think. Thank you, Urte, particularly at short notice. Marvelous job. Let's go back and see if hopefully we can get case study 1 by Fiona on the video.
Hi, I'm Fiona Gatchell, head of the Transactional Analytics team at Equifax in the UK. And today I'm going to be talking about the creditworthiness assessment challenge and what data works best by comparing the credit bureau data to the bank account data. So as an analyst, what am I trying to do when I do a creditworthiness assessment? I'm trying to predict a consumer's capacity to repay without due hardship or over-indebtedness. So in a perfect world, a creditworthiness assessment would be right every time. And everyone who applies for a loan and can afford a loan gets a loan, and no one gets a loan. The credit assessment world is too complicated to be right every time, and that's where the data can help enable us to make more accurate decisions. From our experience when using credit bureau data to make, we are all the time, so room for improvement. And if we can assessments even accurate, then more people will get more credit and consumers will be better protected. So that's the challenge. So how did we tackle this challenge? We did this by building 3 models. One that uses only credit bureau data, one that uses bank account data, and one that combines credit bureau and bank account data. And we analyzed which of these models were the most predictive in helping lenders to make more accurate decisions, and which one had the greatest impact on helping consumers, especially thin-file consumers or consumers with no credit data, gain access to credit they would have previously been declined for. Before we dive into the results, I'll just give a brief overview of what goes into the various models we have built to tackle the creditworthiness assessment challenge. So what are the key data items on the Bureau in the UK? These are primarily credit payment history, bankruptcies, credit searches, and voters register. And this data was used to develop our Risk Navigator 4 score. So typically we see a strong correlation of these data performance, but not all of these data items will cause someone to miss a payment. So for example, if someone is heavily overutilized on their credit card, it may cause them to go into default, but just because someone is not on the voters register doesn't mean they can't pay off their debts. So using the credit bureau as beneficial for consumers with no or very little credit data, and that's where the bank account data can help improve their credit score. So what are the key data items from the bank account information? Income is a key data item, which can be used to verify a consumer's declared income, and data such as rent and committed expenditure have proven to be predictive and add value to credit models. The open banking data is also more up-to-date compared to the bureau data, as we see the open banking data in real time. So all of this valuable information can help feed into assessing the consumer's affordability and can be used to create transactional data scores such as the Financial Health Index. Model 3 is a combination of Risk Navigator 4 and the Financial Health Index, so therefore uses both credit bureau data and the bank account information. So what were the results? So the graph on the left shows the predictive power of the 3 models. Measure the predictive power using the Gini, which measures the ability of a scorecard to rank order risk. So Gini, the more predictive the score. The results show that all the models were highly predictive. However, FHI was the least predictive. Risk Navigator 4 came in second, and in first place was the combined score. So in analyzing the predictive power of the combined, we observe a significant uplift of 10% in predictive power on an internal sample and up to 25% uplift on consumers classed as thin file or those with no credit data. This shows that when using the credit bureau data in conjunction with the bank account information adds substantial value over and above just using either data source in isolation. And we see a much higher uplift on thin file consumers because generally this population may not have much credit data and in turn may get declined when scored using traditional credit scores. However, when analyzing the open banking data, we see this population may have evidence of regular income and may have a surplus in their account every month and in turn may be able to afford to take on additional credit. Therefore, demonstrating that combining both data sources can be beneficial to the consumer as well as the lender. So who benefits most when you combine both data sources? Consumers who benefit are those who may be excluded today, such as those who are in the country or younger. And this graph shows just that. When analyzing consumers under 25 who are not on the voters register and show no signs of financial difficulties, we see a significant improvement in credit risk and uplift in score in this group compared to the overall group when utilizing both data sources. So this demonstrates that consumers such as the ones in this group won't have to wait years to build up their credit profile and can benefit from all new and innovative products that are available and will become available using the Bureau data in conjunction with the bank account information. Thank you.
Thank you, Fiona, wherever you are. That was excellent. All right. So, audience, we're going to go to the panel now. You have a job here, however, so you have to start thinking of your questions. They can be for our panel members, or they can be on the case studies. But I will leave a very long, awkward pause if you don't have any questions until one of you feels so uncomfortable you have to ask. So do get ready with your questions. But let's start with our panel, please. Let's start with the early articles. Let's think about the scope. So we mentioned the scope of the Consumer Credit Directive is set to change to include lower value loans, different types of products, some of the types of products that the governor touched on potentially. Sebastien, let's start with you for a view from the lenders. What's your view on the expansion of the scope?
My colleague, Enrique Velasquez, of course, for inviting us to discuss with you today. I think it's really great what he has done with Axis the last years. Now, on the scope. Well, very topical discussion, as you mentioned. Of course, we're in the middle of the discussion at the Parliament, at the Council, where the Council has already agreed on a common position, and I will comment this position quickly as well, or at least on the scope side. Also very topical, especially the scope. You mentioned yourself the arrival of the iPhone some years ago. You may have seen also very recently that I think it was an article in the FT, but of course it was also elsewhere, that Apple has now also decided to move into finance by offering loans directly to consumers through its new, well, buy now, pay later products. Of course, this is something to be looked at. Certainly for incumbent banks or incumbent and lenders. No, there is no indication that this product will be offered yet in Europe, but I guess it will come soon. And you can imagine that Apple Pay Later, as it is mentioned, could benefit from a huge advantage given the large customer base Apple has already with Apple Pay, but also the large retailers base that already accept those products. This again, back to your question, do we add those kind of products in the scope of the regulation or not, given that they will become most likely mainstream products? Now, as far as we're concerned, the EBF, I must say, and I have to be honest, we're not big supporter of the revision of the directive at the time. We fear that it would only be, add-on administrative burden, information overload without specifically adding benefit to consumers or even helping to, lenders to adapt to the new digital reality, or the regulation to adapt to the new digital reality. That was, I would say, before, but I must admit that since then the world has changed quite a lot as well. I think it was mentioned already many times today. No, it doesn't mean that, unfortunately, the proposal which is on the table has not had own administrative burden and perhaps requirements which we consider disproportionate. But on the scope, I must say that certainly on our side, we were from the start in favor of expanding the scope to all type of lenders. So very important indeed that, all type of suppliers of loan or similar products should indeed adhere to the same rules. When they provide similar products, this is the famous motto many of us have: same activity, same risk, same rules. Very important to add also same supervision. So yes, residualize super overview. I'll come back to that because we're not so happy with the last text which was approved at council level. Now on the product itself, we had some doubt, as I mentioned, that the scope should be extended at a time to all types of credit, whatever their size and duration. I think we have evolved. And although we believe that there are some products which were perhaps added by the Commission into the scope where, in our view, were not comparable to consumer credit, like leasing or perhaps deferred debit card. For the rest, also extending the scope to credit below €2,000, I think at the end is a good thing. Now, the most important issue here for us is, of course, that especially for those products which have indeed smaller size and smaller duration, it's very important to foresee a proportionate regime, because if you add on, of course, all the requirements and cost attached to those requirements to any product, whatever their size and the duration, you may come with, of course, this proportionate requirement and cost, which at the end, of course, will also be transferred to consumers, and this might actually make those products not attractive anymore consumers because too costly, or non-attractive anymore to lenders because too costly as well. Now, on the proportionality, I think fortunately the discussion both at the European Parliament and the Council have improved the text. We are not yet fully there in our view, especially on the creditworthiness assessment regime, which is still, in our view, too perhaps disproportionate for some of those products. Perhaps last but not least, I'd like to insist on that because that was also part of my introduction, and we can go, of course, more into the detail. Where we have some concern and some doubt is now on this possible exclusion, indeed, from the scope of and this famous Article 37. I'm going already quite into the detail of suppliers of goods and services acting as credit intermediaries in ancillary capacity, or indeed acting as creditor in ancillary capacity, which could grant credit in the form of deferred payment to purchase of goods and services. So if you couple that with also the exclusion of the scope in Article 2 of those products, this makes, of course, in our view, concern, and I think we share this view, and it's not always the case with, consumer representative. So to indeed buy now a pay later product, especially from some of the big techs, and we just mentioned Apple coming up with new products, which would be completely out of, I would say, any regulation protection in Europe. So that's of course a big concern, and we sincerely hope this will be corrected in the future. Well, I was already quite long, so sorry for that, but happy to take any question later on.
Thank you, Sebastien. Anna, shall we get the consumer view now? There was a suggestion you might agree with the European Banking Federation, which is nice, you know, for relations, but not great for a panel. So I hope you also disagree with them on some things. What's your view on the scope?
Well, on the scope, our starting point is clearly that we want to have all types of credit products covered, especially those loans below the 200 euros, because as said at the beginning by Pierre Wunsch, is a sector where you have a lot of vulnerable consumers targeted. Now I want to follow up basically on what has been said on these exemption for suppliers of goods and services. That's something which we see now both in the council, but as I hear also in the parliament, and our MEP, Mr. Sokol, will be perhaps able to comment more on this, but it's something where we see that there is a strong attempt to exempt those suppliers of goods and services. And from a consumer perspective, this is really a big problem, because we see in the sector that there is now this strong attempt to offer products such as buy now, pay later products. I mean, you took basically my example with Apple, because that's the big news of the last 2 weeks. But we see there really a strong threat that we have a huge loophole for suppliers of big tech. And we see now more and more, Amazon has now a banking license. I mean, they will all move into the banking sector. And if they can offer credits without being regulated in Europe, I mean, that's a problem for a level playing field. But of course, it's also a huge problem for consumer protection. And perhaps linking it also to your business in terms of credit registers, what we see here is that for buy now, pay later, these soft credit checks which they are doing are not working. So we have a situation where Klarna doesn't know what PayPal does, PayPal doesn't know what Affirm does, Affirm doesn't know what Afterpay does. And that's not an acceptable situation for a consumer, that you can basically shop around and take out multiple small loans. I mean, the average value is 90 euros for a Klarna purchase. But then you take Klarna, you take Afterpay, you take PayPal, and you end up with a huge sum. And especially for young consumers, which are a main target for these buy now, pay later, this will be a huge problem. So we really strongly call on both Parliament and Council now to include credits free of interest, include credits from suppliers of goods and services in the scope of the directive, because we see this as a huge loophole emerging, and a market which is strongly emerging now with a lot of providers coming from big tech to offer these credits.
Great, thank you. Mr. Sokol, I just want to check you can hear us okay. I should let you know you're on an enormous screen in the central bank, and we're delighted to have you with us. If we could come to you next. So the scope has also been one of the areas of most contention within the Parliament. I wondered if you could give us a little update on where you think the Parliament and the committee will land with the scope, and what you personally would like to happen.
Yes, thank you very much. Thank you for inviting me. I have to say that in the preparation, I was told that I will be speaking more, that the question will be related to creditworthiness assessment and the information which is regulated there. But I probably should have assumed that also scope will come into play. I mean, when we speak of scope, we try to find a kind of a balanced balanced solution there. And on one side, definitely protect the consumers and prevent it from creating loopholes. But on the other hand, also be careful so that we don't go too far and be counterproductive. For instance, when we speak of buy now, pay later schemes in some countries, like in my countries, most of the, for instance, mobile phones are bought in that way. And this is something that has proven beneficial for consumers. And we don't have the data that these kind of practices have led to many cases of over-indebtedness. But these kind of possibilities have actually, without buy now, pay later, without any interest, I have to say, have actually helped those people who would otherwise would not be able to buy these products at all. So when we speak about exclusion of this, we also have to speak about the possibilities for these kind of companies who are selling mobile phones, for instance, to actually conduct creditworthiness assessment. Because if we include these kind of practices into the scope of the directive, that would mean that these kind of providers who are not financial institutions, who are not equipped actually to conduct creditworthiness assessment, will have to actually conduct these kind of assessments on the spot when they are selling mobile phones. And what we fear is that if we include this completely into the scope of the directive, that what will happen is that they will just revoke any possibility to actually pay in installments. And this is a problem because if the end result is that the consumers lose one of the possibilities to buy products and pay in installments, that this will actually not be beneficial for consumers in the end at all. But this is the only thing that has been left outside of the compromise for now. We are trying to find some wording which would, on the one hand, prevent this kind of a scenario whereby consumers would be left out without the possibility to pay such products in installments, but on the other hand, also not to create some kind of loopholes that others could exploit. So since we are conducting negotiations at the moment, I cannot go really too much into detail on the exact wording, but we will try to find a kind of a balanced solution on this. But if I may, I would also like to say something about the other aspects of creditworthiness, if that is okay as well.
Please do, yeah.
Okay, so thank you very much. So the first point that I wanted to say that because of these final negotiations, the vote on the report has been postponed, so it will not happen in this week in the IMCO committee. But what we hope that once we find a common agreement on this final point, that we will have an extraordinary session of the IMCO by the end of the month, so that we can go through the plenary procedure before the summer break, so as soon as possible. So this is what we hope. So if we find an agreement to have a special extraordinary committee meeting before the end of June to vote on this, so that we do not lose the entire summer. And so on the assessment of creditworthiness, I think that this is at the heart of the directive, and the very complicated negotiations took part related to this. What was important for us was also to try to balance on one side consumer protection, but on the other hand also the concretization of the principle of proportionality. So when we speak of consumer protection, so what we wanted to also prevent, that was not really mentioned today, was to prevent consumers from turning to the black market for credit, which would be the case if we go too much into the direction of too much regulation and having too restricted legal regime for creditworthiness assessment. So one part that we wanted to include was a very limited exception related to cases where creditworthiness assessment has been negative. So what we added in the normative part, that creditors may exceptionally make credit available to the consumer in specific and well-justified circumstances, which include healthcare loans, so loans that fund exceptional healthcare expenses, student loans, or loans for consumers with disabilities, but provided that consumers are informed about negative credit assessment that may lead to over-indebtedness. So we believe that these kind of very exceptional circumstances should be included, and that in case you need the credit to pay for some exceptional healthcare expenses, you should be able to do that, even if the creditworthiness assessment is not positive, but then the consumer needs to be informed of that. So, but these are very limited exceptional circumstances in very specific cases. So this is the first point. In relation to the implementation of the principle of proportionality, so we wanted to introduce a definition of small value credit and ensure that proportional creditworthiness assessment applies to such credits. Of course, so there was a lot of pressure that these kind of loans are completely excluded from the directive. So that's one, let's say, extreme point on this. And the other extreme point is that we have a very detailed and close list of data prescribed by the directive, which should be used in when assessing creditworthiness of these kinds of credits. So we believe that this is too much, so that these kind of credits should be included, that they should not be left out of the directive, even though there were some pressures that they should, but also not to go too much into over-regulation, especially in the directive itself. Because if you prescribe a closed list of data that should be used to assess creditworthiness, very detailed list of data, and if you put this in the directive, and also for small value credits below 200 euros, then you will really create something which we believe that definitely goes too much, and that is too rigid, that is too detailed, and that cannot be changed. Because if you have a closed list of data in the directive that you use, if circumstances change for any reason, if you find some more research, some more data on what kind of data should be used, and you want to change this, then you have to go through all of this painful, through this whole painful procedure of changing the directive itself, which means that if we want to include some additional piece of data, then you will have to change the directive, have a commission proposal, and the parliament and the council and the member states having to implement it, etc., etc. So what we believe that this was just too much. That the directive is that we should provide some kind of a different solution instead of having a detailed closed list of data that should be used prescribed in the directive itself. So what we did prescribe in the directive, and I believe that this will be in the final compromise, is first the data that will not be allowed to be used. And here this means personal data revealing racial or ethnic origin, political opinions, religious or philosophical beliefs, trade union membership, processing of genetic data, biometric data for purpose of identifying a natural person, health data concerning a natural person's sexual orientation, data collected from social networks and things like that. So these are the things that cannot be used, and this is prescribed in the last version of the compromises in the compromises on the directive. So what was also very important for us is to explicitly exclude health data, and also to include something which I believe is already included in the Belgian legislation, and that is the so-called right to be forgotten for cancer survivors. So and this is something that we also included in the final version of the compromise, so that the data on cancer survivorship cannot be used after 10 years have expired after the end of the treatment, and 5 years after the end of treatment for patients whose diagnosis was made before the age of 80. So since we have different rules in different member states on this, on the rights of cancer survivors, we wanted to harmonize this on the European level, so that we don't have different rules in Belgium, France, Germany, etc. Okay, so this is also something that was included, and on the data itself that should be used. So we defined which data should not be used, but on the aspect of data which should be used in the directive, contrary to the closed list of data, we have actually given a mandate to the European Banking Authority to develop guidelines which detailing how creditors and providers of crowdfunding credit services should perform the creditworthiness assessment. And these guidelines should specify the type of data recommended to perform the creditworthiness assessment. And what is also important here, that also proportionality is included in that sense. Also, we prescribed that when developing such guidelines, the European Banking Authority shall take into account the interest of the consumers and the protection against over-indebtedness, take into account the types of credits offered in the EU, and detail specific recommendations for specific credit offers if deemed necessary, and consult relevant public authorities, stakeholders, as well as civil society and consumer organizations. and these guidelines shall be reviewed every 2 years. So the whole idea here was actually to have a body which we believe is better equipped than us politicians to define which actual data should be used, but also that this system is flexible enough that it can be changed if new information, if new studies emerge which show us that something else needs to be included or excluded. But and we believe that this is a much better solution than having a detailed, very long, closed list of data prescribed in the directive, which will be very rigid and could not be changed without changing the whole directive. So this is what I wanted to say. Also, when we speak of things which have been explicitly excluded that we have an agreement on from the scope, also there is operational leasing, deferred payments to be paid less than 45 days from delivery of the good or service, and deferred debit. So this is something that has been agreed upon up until now, and as I said, we are still conducting the negotiations on these buy now, pay later schemes. Of course, as I said, we want to prevent kind of loopholes from emerging, but we also do not want to have a result that these kind of products are not offered to consumers at all, because we believe that this is beneficial for those consumers who are actually able, who are not able to pay the entire amount of for a mobile phone, for instance, on the spot, but if they pay it in installments, then this is something which becomes possible. But I won't, as I said, since we are conducting final negotiations on that, I cannot go too much into detail, but I believe and hope that final result of these negotiations will be a balanced one. So thank you very much, and if you have any comments or questions, please.
Thank you very much. That was a tour de force summary, I think, of the proposals and the debates that we have at the moment, but also some of the tensions between giving consumer protection but being proportional, keeping products in the market so consumers can access them, but also making sure when they do that they're protected, and the pros and cons of specifying what type of data should and should not be included in creditworthiness assessments. David, I'm going to let you respond to any of that. What particularly leaps out for you? Perhaps maybe around the creditworthiness assessment is particularly exciting for our audience here. So I wonder if you could set out maybe some of the Commission's thinking on that.
Thank you, and good morning to everyone. Thank you for inviting the Commission. It's always a pleasure to be here around the experts and especially practitioners. Let me just confess, and I think this is not a secret, that there are two main building blocks in this proposal, and these in fact concern scope and creditworthiness assessment. These are the two basic pillars of the proposal. They are the two basic pillars on which everything is built on, and therefore it is very important that we get them right. It's also very important to say that even though the Commission works very hard and we proposed on the 30th of June the best possible proposal, it is enriching to meet stakeholders, to have this discussed by the co-legislators, so that at the end of the day, what we will have at EU level is a very much better product, better legislation, sound legislation, which will be to the benefit of both the consumer and to any practitioner who will be using this legislation. If I can just open a small parenthesis on scope and then, of course, focus on the creditworthiness assessment. I would like just to bring in at this stage the work that was done before June to give just an indication of why the Commission has presented what there is in regards to the scope. And indeed, Stuart, you mentioned this, that 2008 is a long period of time. So in 2008, a lot of things have developed. There has been digitalization. There have been new market players entering. Therefore, what we have done at the Commission, and this was published in 2020, is need an evaluation which clearly points out to the need to revise the CCD. So this is why we came in 2021 with a revision. Also, if you look at the public website of the Commission, you'll see also that when we published the proposal on June 2021, there's also an impact assessment. So in this impact assessment, the Commission has to do a rigorous exercise whereby it has to justify any changes it makes. One of the big changes indeed in CCD II is the scope. There, The Commission, us drafting it, we have been subject to rigorous tests, and indeed I can publicly tell you that on one particular instance, the internal cuisine of the Commission, so we have to present our proposal to what we call the RSB, the Regulatory Scrutiny Board, the RSB, and there they told us that on one element, on the scope, we went overboard. So they said that, for example, pawn shops. So if you look at today's CCD I, and you also look at this proposal of CCD II, pawn shops are outside the scope. The beginning, internally, we were thinking of putting it in the scope, but there was no justification. We failed the proportionality test with regards to these pawn shops. Therefore, when we came to propose it in 2021, June, pawn shops are still outside of the scope. So in fact, the first point that strikes me, and which has been quite important, is that when we speak about proportionality, I think we have to get the terminology correct, because proportionality and necessity has already been conducted according to the necessary co-legislator rules when the Commission published the proposal. What we speak now, and what we speak about these exclusions, are more like lightweight measures, burden, reduced costs for certain products. So I think it's important to get the terminology correct, because what we try to do and what we see in Council and Parliament are policy choices, which can be legitimate, whereby the idea is to reduce or take out from the scope certain products. In the Council's instance, deferred debit cards have been taken out. That has been a policy choice by the Council to clearly remove that. It's a policy choice. There is nothing proportionate in it because the proportionality was done before, but it's a policy choice. Now, that was the procedure. If we go to the substance of the scope, just two things. We always and quite normally use this slogan: evolution, not revolution. Why? Because what we have seen is that CCD I works, but it needs to be improved. Also when it comes to both creditworthiness and the scope. When it comes to the scope, the Commission is not against, or the Commission is not interested in excluding ab initio any product. There is no whatever reason why a product should be excluded or not. What the Commission is trying to do by widening the scope is to ensure a level playing field, ensuring also that the consumer is made aware through pre-contractual information and through the obligation of creditworthiness that at the end of the day, the loan provided will work. At the end of the day, the creditor will get his repayments back. So this is quite important. This is quite important that there's no like sort of witch hunt from the Commission towards certain products in the consumer field. What we want is simply to have a better set of rules which are for the benefit of everyone. So this is, I think, more like general philosophical discussion on the scope. Of course, we can go into details and see whether certain items excluded are really justified or not. But this is something else, which we can go even later. With regards to your question, Stuart, on creditworthiness assessment, indeed, again, it's an issue of evolution, not revolution. Why? Because if you look at the current CCD I, and what we have tried to do in CCD II is indeed look in the ecosystem of what we are operating around. We have the Mortgage Credit Directive, which dates from 2014. We have the GDPR, which was agreed in 2016. And these are indicators we took these as indicators for the CCD II. Why? Because what we try to do is to bring added value. Therefore, the evaluation, which I mentioned at the beginning, clearly pointed out that the term on the basis of sufficient information found in CCD I for creditworthiness was overtly broad. It was too broad, and this ended up with different member states having different rules. Therefore, what we try to do, without going overboard, without being disproportionate, without trying to exclude anyone, we used the wording found in the Mortgage Credit Directive. So the data which can be used can be economic or financial data. And there we avoided this discussion about blacklist, whitelist, purple list. Why? Because we think that this should be functional, and this is very important. That, and you are practitioners, you know, we saw in the case study the amounts of data, the categories of data, the numbers and limits. It also depends. It's quite functional. So inbuilt in the creditworthiness assessment, there's this sort of proportionality. So I think what stands out is also there's no one-size-fits-all creditworthiness assessment. Therefore, if the loan is a sub 200 euro or a loan is 10,000, if you know the consumer, if you don't know the consumer, these are all different factors which come into play, and therefore this is why we should not think that we are building something which is really like baroque and closed, but this we try both in the scope and the creditworthiness assessment to ensure this element of flexibility, which in legal terms is proportionality. So this is, I think, at this stage what I would like to say.
Thank you, David. Okay, so I'm going to do some, oh gosh. I have one job, turn on the microphone. Rapid fire questions in our time remaining. We have one from Martin for you, David. Will the right for credit reference agencies to process data and bank account data as a data controller be clarified in EU legislation? Will that be part of the CCD? It can be yes. I think the answer is no. But maybe that's one to pick up. We'll come back.
I think the elements are already there. No, it won't. Yeah. It is not. If I understood the question correctly, is whether there's going to be specific legislation.
Marvelous. Okay, thank you. Urte, if I may come to you on content of databases and whether the CCD should specify what data can and cannot be used in a creditworthiness assessment. What is the SCHUFA view?
Yes, so thank you. I think we already heard today that the quality of creditworthiness assessment is decisive to protect consumers from over-indebtedness, but on the other hand, to financially include them. And as we have seen with the case studies as well, creditworthiness assessment is not an exact science, and so it is important to have flexibility in the use of the data categories, because we also do not know which data might be relevant in the future. For example, if we have a look at open banking data, 10 years ago, we didn't know about open banking data and the potential of open banking data, and maybe there will be new data categories in the future, which come maybe from digital currencies or whatever we might think about. So we need to have this flexibility to use this data for creditworthiness assessment if they would be a benefit for the consumer and to protect the consumer at the same time from over-indebtedness. And I think what we also saw in the case studies, maybe doing the link to using positive data categories for creditworthiness assessment, that especially positive data categories such as information on a trustworthy repayment behavior and in the past can be of a really beneficial information for consumers, because like this they can prove that they have been trustworthy and they can afford credit. So this is an information that is of a big relevance, and I think this is also reflected by the World Bank wanting to include these data categories into the creditworthiness assessment, but also in the BEUC guidelines or the mortgage credit directive. So I think that it's important to have this flexibility and not defining a closed list of data for the creditworthiness assessment.
Thank you. Okay, I think we've learned a lot there. One, I'm a bad moderator of these events. Sorry not to give the panel a second chance to come back. Please do grab them in the free time if you want to ask them any questions or clarify anything, and they will be delighted to speak to you. Thank you to all of our panel members, and particularly MEP Mr. Sokol for joining us remotely. The CCD, we've also had a news flash that the vote is being delayed, so there's a little bit more time for those of us who are involved in making arguments to Parliament to keep pushing those on the back of today's event. And I will now hand back to our wonderful chair and president, Enrique. Thank you.
Thank you very much, Stuart, for steering this discussion.